Hi, everyone. A new week, and markets are still very optimistic about what's going on in Iran. We're continuing to see those ceasefire vibes, although we're recording this on Tuesday. The ceasefire actually expires on Wednesday. So we need to see a potential for that to be extended, I think, to continue with the good news. We ended last week with US stocks at record highs, the NASDAQ and the S&P 500. We've got a number of stocks making fresh record highs just this week, including Dell, and we've also got Texas Instruments as well. Lots of stocks, consumer stocks as well, at 52-week highs. So that's the annual highs. Which is really quite interesting and suggests that the market is being very, very optimistic about the outlook for events in Iran. And crucially, why all of this is happening is because the oil price is comfortably below $100 per barrel. Now let's dive straight in the charts and we'll have a look at what's going on. This is Brent crude. It is a CFD on our X Station platform. This is just a 5-day chart, so it's just really, really short term. But obviously on Friday, we had that news that the Strait of Hormuz was open. We saw an immediate dive lower, back down below $88 per barrel at one stage. And since then, we have obviously moved higher because there's not been so much good news. And we're trading around below $95 per barrel in a fairly tight range, actually, when we look at it. So essentially over the last few trading sessions, 3 trading sessions, we're trading kind of between like 88 on the downside and about 96, 97 on the upside. So it's kind of moving sideways. We're in a bit of a holding pattern, but crucially, really crucially, below that $100 per barrel level, which is really, really significant for psychology, for the economic outlook, for what central banks do, for all of these really fundamental things which drive other asset classes. Now, if I just pull up the US 500, or otherwise known as the S&P 500. This is a longer-term chart. As you can see, just a really nice move higher in recent days. If I just go even onto a year, sorry, bear with me one moment. As you can see, just a really lovely chart. The uptrend is still intact. We've recovered and then some from this war in Iran. So stocks are just away. Partly that's due to earnings season. We've had a very strong earnings season so far, although we're getting about 80 S&P 500 big US names release their results this week. Results last week, there was about 50 companies that reported, but we've seen, way more than 4/5 have reported stronger than expected results. So that is the first quarter of the year, but that does also include March, so the peak of the war with Iran. So, and that energy price spike. There hasn't been too much concern about the energy price spike. There are still expectations that the war will be short and that the consumer can kind of see through this, that the Fed can look through it. A lot of optimism. Some analysts out there are saying maybe that's too optimistic, but I think that where the S&P 500 is, the main US blue chip index, just says it all really. There's a lot of optimism in there, and you can see these big green bounce back. So essentially what it means is that market, you've got to be quick if you want to get into the S&P 500 at a decent level, because every time it falls, there's always buyers to pick it right back up. It didn't feel like that in March, but this just goes back to that point of being invested, staying invested, investing over the long term, and you can really ride out those bumps, which is kind of really important to think about. Now, I also want to show you BP. BP in the longer term hasn't looked so great, but BP in the past year has had a stunning year. This is an annual chart. If we look at a 3-month chart as well, you can see absolutely surged throughout the crisis, surged throughout March, up 30% on the year, but it has backed off as the oil price has fallen. So oil majors are coming under a bit of pressure. That is limiting FTSE 100 upside, actually, I should say. Even though the S&P 500 are making record highs, we're seeing a bit of a slower follow through in Europe. And that is because Europe, more prone to inflation, still have a bit of a supply crunch when it comes to oil, because we don't produce enough ourselves. So we're still vulnerable to what's going on in the Middle East and to a shortage of oil. Jet fuel, for example, is there as well. And that, I think, is just something to watch out for. I also want to show you an airline. Because Delta has reported results, and it did very, very well in its results, but it did say that it was going to take about a $2 billion hit from the oil price, and that's kind of weighed on it. If we look, as you can see in this chart here, if we look at IAG, which is a stock, which is obviously a conglomerate of of companies there. It's done a bit better actually. It's partly recovered from its decline. That's because the bigger conglomerate airlines, so that includes BA, Iberia, and a large number of others, but they are able to kind of buy in bulk and they're hedged in the future. So if the jet fuel price does fall on the back of falling oil prices, then that is kind of good news for the airlines. So the airlines is a bit of a mixed picture, but obviously they're still front and center because this war is still going on. Now, I'm going to start, just bear with me guys, because I'm going to start sharing my Bloomberg terminal rather than just this one. And you will see, you should see this any moment now, which is my typical, it is the World Equity Index. And as you can see, if you follow my pointer here, it's just a sea of green in Europe. Futures as well pointing to a stronger open in the US, but it's not just the US that's reaching record highs. The Kospi in Asia did as well. So that's the South Korean Stock Exchange, been on a real tear higher this year, and it fell very sharply in March, but it has bounced back and fresh record highs. The Nikkei was up nearly 1% today. Chinese indices doing really, really well, a 0.5% increase for the Hang Seng. If we look at the past month, just look at this bounce back. Europe is lagging, but the Japanese index is doing really, really well, outpacing the S&P 500, but it is the NASDAQ that is really powering forward. And then European indices, they're also doing well, but they're just not doing as well. As I mentioned, the FTSE 100, it's up 7%. That compares to 12% for the NASDAQ, 9% for the Eurostoxx 50. It's being held back a little bit by those oil majors, which are coming under a bit of pressure. If we look more closely at the oil price, this is it just today. And as I said, it's like, yeah, still trading below 100, below 95, still well below $100 per barrel. Just look at a slightly longer term chart. A lot of noise in this picture, huh? But one thing that we've done, we haven't gone back to those highs that were at the beginning of this month, and we haven't also gone down to the pre-war levels. We're still above the 200-day moving average. So there's a long way to go, but definitely there is a feeling of calm in the markets that all of this will be worked out. Is that misplaced optimism? We don't know. We do know that there are talks going on, hopefully to extend, between the US and Iran to extend this ceasefire, but it seems like, there's been no updates today yet. So it seems like they will really go down to the wire. So we need to watch that really, really closely. Now, Tesla will report earnings on Wednesday. We are all watching for those. Tesla is one of the most kind of traded stocks. Volume is always high. It's one of the most traded stocks at XTB as well. People absolutely love Tesla, especially around earnings reports. It doesn't have a great history with earnings reports. 2 out of the last 3 earnings reports, its stock price has actually fallen, but it does go into this report in a slightly better position, largely because earnings in 2025 were better in Q4, but overall revenue actually fell compared to the year before. That was the first time ever for Tesla actually. So that means that the bar is lower, and revenue is expected to increase relative to the first quarter of 2025 to the tune of about 40%. So looking for some pretty decent earnings. That's due to a bounce back in sales, even though deliveries missed forecasts. There was an increase, very positive development in Europe with sales coming back now that Elon Musk has stepped back from his political role. From a technical perspective, going into this earnings report as well, we are above the 200-day moving average. That is 399. Sorry, we're testing the 200 moving average, I should say. Currently trading at 392. 399 is just below that 400 level, is the 200-day moving average. We're definitely testing that, but I think we need to wait for Wednesday night's earnings report to really get us over there. If it does, remember, when it comes to Tesla, you don't necessarily need to see really big numbers, but you just need the market to really believe in what they're saying. AI spend is going to be really important, as I wrote in my week ahead notes. Now that's on our website. You should read that. That's got an earnings preview for that, and also for Intel report results on Thursday. These are kind of the first of the AI majors. Obviously, Tesla is the first of the Magnificent Seven to report results as well, so that's worth watching. But the fact that the Magnificent Seven and the tech stocks are really kind of leading the S&P 500 higher does say something. It does also mean that there's more focus on this earnings report. Well, there's always focus on Tesla earnings report, let's put it mildly, but it is always the first of the Magnificent Seven to report earnings, and it is expecting, in fact we can look at it here, what the market expects. We are looking for earnings. taking a little bit of a while to learn. Revenue of 22 billion, net income or profits of 1.2 billion. Now, if you look at this 4-week change, don't worry, that isn't those negative numbers are just how analysts have actually revised down their forecast, because they had them so high, so they've revised down, so they've lowered the bar for Tesla. But as you can see, in the longer term, the move can be very, very sharp on the back of earnings reports. But over the last two out of the last three earnings reports, Tesla's share price has fallen. But there is definitely a kind of more positive mood going into these earnings reports. And as I said, a very technically significant level as well, testing that 200-day moving average, which is around about that $400 per mark level, currently trading at 392. If we look at the best performing sectors in the S&P 500 as it's rallied to these record highs, comfortably above 7,000, above 7,100 in fact, you can see what's kind of driving it here. So you've got you've got stocks that tend to rally when the outlook is positive. We're not seeing oil and gas rallying here. We've got, in the past 5 days, we've got automobiles, we've got system software up 9%. Those software stocks that were sold off, well, that is now a thing of the past. People are really pushing forward. A footwear index up 7%. That was due to some results from Nike, and also those Allbirds switching to AI as well. If we look over the past month, you also see a real shift in what's moving. Obviously, you've got some copper and steel and kind of these big gold indexes recovering as well. So we're seeing kind of copper and steel, when they're moving higher, that is a sign that the market is not so worried about the oil price and is also very positive on the outlook for growth. So those are the things to keep in mind, that this is a very supportive market for risk sentiment. It's actually, the key thing is, it's hard sometimes to get into it. And as you can see here, if we just look at the overall Magnificent 7 index, this includes all of the performance of the whole Magnificent 7, so the 7 biggest tech firms, well above its 200-day moving average now. And that, you know how the saying goes, anything above the 200-day moving average is good for stocks. So there's real kind of positive momentum building. It looks like it's hitting a bit of a top there, but I think that, that will be temporary. And we just seem to be moving, it's the rear view mirror, what's going on in Iran, moving forward and in a much more positive outlook. We also have as well, we have some big UK data this morning. We had much better than expected unemployment rate, which dropped to 4.9% from 5.2. The pound, however, is really static. It's barely moving at all, but managing to stay above that 135 level, managing to stay above that 200-day moving average level. As we move into this kind of new post-war era, although the war is not over, so that is a big sign to do be careful, make sure that you're covered, you've got your stop losses, but that's when you see the move above the 200-day moving averages and staying above that level. Obviously, the level to beat is 136, and I think we'll need to see, probably need to see the war in Iran fully over, an extension of the ceasefire for us to go back to those highs, and for the dollar interest to really start to wane. But I think long term, we are not that supportive of the dollar going forward, particularly if the diplomatic negotiations continue on, and then. Yes, let's look at just what to expect tomorrow from the CPI data for the UK. Tomorrow we've got CPI, markets expecting it to increase to 3.3% from 3%, 3.2% for core. So that's fairly mild, moderate increase, which suggests that inflation, yes, it is moving higher because of the energy price shock, but we expect that all to be because of the energy price shock. And it'll be interesting to see what other prices do. Just a quick look before we go. Interest rate expectations. So this is the US, 1 rate hike now. Nearly 1 hike priced in over the next year, but no change expected. Remember, we've got the new, the Trump's nomination for the Federal Reserve. He's testifying to the Senate today. We want to see whether or not he's as dovish as expected. Overall, I don't see too much change here. And if we just look at the UK as well, because obviously we've got all that data, labour market today, we've got CPI tomorrow. Bear with me. Pull up the right chart. As you can see here, so we're just looking at just over 1 rate hike over the next year. So really scaled back as things normalize. Now, guys, thank you so much for joining. We appreciate your continued support, and please do follow for more, and check out our YouTube channel and obviously our website where we keep all of our analysis. Thanks so much.